What's going on, everybody? Liam O'Reilly, Vermont Economic Realtor with Jerry Riley Real Estate. Hope you're doing well. The Federal Reserve hiked their Fed funds rate by 25 basis points the other day. I'm sure everybody saw that. What does that mean for interest rates? What does that mean for the housing market here in Vermont and nationally? So let's go over a few things. So obviously, the headline was that they raised the Fed funds rate by 25 basis points, and another interest rate hike in what's been a year, or I guess over a year now, of hiking the Fed funds rate very significantly. But if we look at what happened to mortgage rates right over here at NEFQ, mortgage rates dropped a little bit. They were sitting at about 6.25%. Now they've dropped down to 6%, despite the Fed funds rate raising, or despite the Federal Reserve raising their Fed funds rate. And I think a lot of that had to do with the bond market. The bond market dropped despite despite the Federal Reserve raising the Fed funds rate. And people are rushing into bonds, rushing into safer assets, and as a result, the bond market and the mortgage market are held tightly together. And so I think that's part of the reason why mortgage rates dropped slightly. Now, obviously, unemployment is still low, and the Federal Reserve touched on that in their speech. And they said that they're going to stick strong to bring inflation down. That is their goal, which I mean, to be honest, it would benefit everybody having stable inflation. But I wanted to touch on a few more things that they said. It sounded like, at least to me, that this is probably the last rate hike that they're going to do. Now they haven't made any decisions yet, but it seemed like they were leaning towards, at least strongly considering pausing at the next meeting. We'll see what they end up doing. It wasn't, in their past speeches, in Jerome Powell's past speeches, he has said that that everyone's leaning towards hiking again at the next meeting. This meeting, it wasn't so much about that. It was, we're not sure exactly what we're going to do. We're going to look at the data and we're going to go from there. Now, it seems to me that they're going to pause after this. Inflation is slowing. It's coming back down to the levels that they want it to. And there's some cracks in the economy. As we talked about in my most recent video, the banks are really struggling. If we look at this article here with some more banks that are under pressure, I believe this is at PacWest, tumbled 45% on Thursday, and Zion Bank fell 12%, Western Alliance down 27%. So these banks are in trouble, and what I think is going on, from what I can tell, is the depositors have fled to money market accounts. So these banks have less deposits because people can get a better return in money market accounts or buying U.S. Treasuries as opposed to keeping their money in the bank and not earning any interest rate. So these banks don't have the reserves that they need, and some of their assets aren't doing well, whether that's commercial real estate, whether that's bonds that they bought when interest rates were low. Their asset values, I think at a lot of these banks have dropped. Now, I haven't dug deep into exactly what's going on with the specific banks that have seen major declines, but I think as a result of the Federal Reserve raising their rates, some of these bank assets have declined. Their reserves have fled, at least at some banks, and they're starting to see trouble. So I think, as far as the Federal Reserve's next move, I think the banking issue and the struggles going on in the banking system is going to really dictate their pause and eventual cut. Now we'll see how this ripples into the rest of the economy. I think the banking issues in general aren't great for the real estate market. They're not great for supply. Now, really what's going on in the real estate market is, almost nationally, we don't have enough supply to satisfy demand, even with higher interest rates, even with interest rates at around 6% or higher. So when these banks start to fail, a lot of these regional banks, these smaller banks, are lenders for local businesses, including construction companies, including real estate companies, people bringing new housing supply to the market. So as these banks start to fail and as people tighten up, as these banks tighten up their lending standards, that is downward pressure on supply in the market. So I think as these banks start to fail and as more cracks start to reveal themselves in the banking system and lending tightens up, that we're going to see less supply coming to the market in what's been already an undersupplied market nationally as a result of the underbuilding that we've done over the past 10 years. If we look at the building that we did leading up into 2008, you know, we so many homes were being built, so much new supply was coming to the market on a yearly basis compared to what we've done from 2009 until where we're at now in 2023. And if you look at demand, even or new starts now, they're well under their peak, their recent peak in 2022. So what does this mean for home prices and home values? I think that even if we see a spike in unemployment, even if banks start to collapse and the economy starts to fail, or at least gets worse than where it's at now, I don't think we're going to see drastic price decreases across the country, at least not here in Vermont. We'll see what happens as we move into the future, but here in Vermont, Vermont is an anomaly where supply is very tight relative to demand in our market, especially compared to other markets across the country. But if we, markets like Vegas and places that are already seeing price declines, places that have a bunch of supply, if we start seeing more cracks in the economy and people start losing their jobs, unemployment goes up, the economy starts to, we enter into a recession or a depression. I think that, in parts of the country that are seeing prices come down, those are going to be the prices come down already. Those are going to be the parts of the country that see prices decline further because of the supply demand imbalance, right? If demand gets hurt due to a worse economy, then prices are going to come down even further. But here, here in Vermont, again, in my opinion, it's really a supply issue. And depending on where things go, where the economy goes, if we do enter into a recession, if we enter into some sort of economic depression, it's really going to be about how hard is demand hit around here, and will demand be brought down below the levels of supply in the market? And I'm not sure it will. I think we really need more building, and the troubles in the economy, the banking issues, things like that is not going to help supply and not going to alleviate the pressures, the price pressures in at least the local Burlington, Vermont market. So anyway, Liam O'Reilly, Vermont Economic Realtor. Let me know what you guys think. Leave a comment in the description. I always love hearing from you. Do you think this is the last time the Federal Reserve is going to hike rates? What do you think this means for the U.S. economy? Let me know. All my contact information is in the description. If you're looking to buy or sell a home here in Vermont, I'd be happy to help you. If you're looking in another part of the country, I'd be happy to find you a great realtor who knows what they're doing. Other than that, I'll see you guys in the next video.